Welcome back to You Heard It From a CFP. My name is Matthew Coyle, episode 66 of You Heard It From a CFP from what is now sunny Minneapolis. We're finally getting some warm weather here. Worst winter, almost the worst winter we've had in 50 years. So finally, we're getting on the warmer side of life. We're going to talk about recessions today because we're definitely having one, right? I keep hearing about it, and unless we don't have one, so I'm getting kind of confused. But let's talk about what happens during recessions, how long the average recession happens, what do stocks do, how long does it take to recover from a recession for the stock market, and should you even really alter your investing strategy in a recession anyway? So we're definitely going to have a recession is what I've been told, even though I don't see it yet, and it's definitely coming unless it doesn't. Kind of confused. So let's talk about it. Let's dive in. All right, so the dreaded R word is back in play again, recession. And you know what's interesting about these phrases and things? You know, you can actually go to Google Trends and look how often a word is Googled and such. So if you Google the word recession and find out how often people Google the word recession, this is the I'll put the chart on the screen right here. It is how often the word recession is entered into Google as far as search terms. And actually the word recession has been Googled more as of June 2022 than any time dating back to January 2004 because, of course, we don't have much data beyond that. So you can say that people are looking up the word recession more than they've ever looked up on Google, which is pretty fascinating. But what the heck does it mean and why does it matter? So I'm going to put a few things on the screen here. We're going to talk about investing during a recession. Should you change your strategy during a recession? What does it matter about investing during a recession? Like, do they even matter and how long do they last? So the first chart I will put up, and I've got a few charts to go here. So let's just jump right into it. If you look at the S&P 500, we'll use the S&P 500 large company stocks as a proxy, the 500 largest publicly traded stocks in the Standard & Poor's Index. If you compare shaded areas there on the screen there with recession stock performance, it's pretty clear from the chart that recessions are at least somewhat correlated with bad stock performance, but it's not obvious exactly how it is. Does the market fall before the recession begins, during the recession itself? Is it worse given the duration of the recession? So it's very interesting to look at what these particular trends look like. So we'll start off by looking at performance during recession. So since everybody's looking at the word recession, of course, it seems like, let's look up performance during a recession, 1950 to 2022. This data comes from the NBER, which is the National Bureau of Economic Research, which is a pretty dependable source. So we'll start with S&P 500 performance during recessions, 1950 to 2022. You can see the big dog in the room there, of course, 2008, the GFC, which was a pretty poor period. But it shows that over the last 50 years, if you index it back to the performance back to the day where the NBER actually said the recession started, a couple things do stand out. So first of all, most recessions actually last less than 1 year. In fact, only 3 of 11 recessions post-1950, since 1950, went on for more than a year. So fairly interesting there. So if you can take the pain of a recession in the short term, you are better off staying invested because they don't last all that long. And when they do, most of them aren't too bad. Most of them did have a significant stock market drop that was quick after the recession began or shortly before it began. But by the time things have recovered, about half the time, 5 of 11 times, the market is back above break even by the end of the recession. So, in fact, our most recent 2 recessions have each been fairly kind of an outlier, in that 2008 was by far the worst. And, 2020 certainly had the steepest immediate sell-off because of the COVID situation, but it was also the shortest recession on record at about 60 days. So most recessions don't last all that long. If you're willing to take the pain and willing to stay invested during that time frame, the performance can be substantial, and we'll jump into that really quickly here. Okay, so I did a video back in episode 60, I believe it was, where we looked at the average recovery, or the recovery during the late 70s when rates started to decelerate, or rates started coming down, or the expectation, let's say, for rates to decelerate became very apparent, and how quickly the market recovered. So that was episode 60. I think you can find it right here, or go down to the video feed and look down there. But basically, if you are in the business of trying to time things during recession, you might be wanting to reconsider that approach, because if you're changing your strategy and trying to time everything on the way down, on the way up, most recessions, the recovery is actually fairly quick and you're very likely to miss it. So let's look at the performance data post-recession. So let's look at average performance of after a recession. So 1 year after the recession is officially called, as far as according to the NBER, the Bureau of Economic Research. In the S&P 500, performance 1 year after recessions, again, same data, 1950 to 2022, but let's look at the average post-recession performance in a major index like the S&P 500, okay? Again, this comes from the NBER, and if you look at the performance post-recession, it's pretty clear looking at the data anyway, that the 1 year period after the recession formally ends produces some positive returns. In fact, the average post-recession return in the S&P 500 1 year hence, okay, is 15.5%. Some more, some less. But the point is, if you are trying to time things, you're probably better off just staying the course as far as being a long-term investor. Now, I have said many times on this channel, anybody who watches my videos knows, that I will tell you, if you have an immediate need within 3 years of your money, if you need money for home purchase, major debt repayment, education, do not put that money in the stock market. Find some treasury bills, especially today. Find some treasury bills, find some long-term CDs, find anything that is conservative, and just use that. Or just keep some cash if you really want to in a money market fund. Do not put that money in the market if you need that money for sure within the next 3 years. Do not do that. Please do not do that. If you are a longer-term investor, you have part of your portfolio, even if you're retired and you have part of your portfolio designated as long-term holdings, maybe for a trust account or for somebody else, then you are probably better off just staying in the market in general. Whether it's the S&P 500, that's to be debated. Wherever you want to be exposed there, I don't know. But using the S&P 500 as a proxy, because it's so commonly used, the average post-performance 1 year after the recession is officially called is about 15.5%. So if you have the patience and you can wait. Realistically, waiting through a recession, if we even have one, and we don't know if we are, is historically the best thing to do, and it certainly is backed up by the data we have there. So now that we've explored that a bit, let's talk about whether or not we are seeing any evidence of a current slowdown. Let's talk about that. So there's a very good argument to be made, and I will try to make it right now, that what we simply saw in 2020, 2021 was a pulling forward of earnings, not necessarily a dip now. So let's take a look at a few sectors within that data, within the S&P 500, and I'll keep this as simple as I possibly can. We'll look at some different sectors, say, healthcare and communication services or industrials and different areas of the market, and say, are we having a recession, so to speak? And we could, I don't know. Or did we just pull forward quite a bit of economic activity between 20 and 21, and now that we're in 22, 23 period, are we just seeing a slowdown because we pulled so much revenue forward and so much economic activity happened in 20 and 21 that we're just not seeing as much of it in 2022 and 2023? That's a real distinct possibility. So let's start by looking at the S&P 500 in general. If you look at the earnings, the revenue surprises in the S&P 500 during the last, let's say go all the way back to 2009, okay? If you look at the data and when the earnings and revenue surprises came in, you see this across different sectors, not just the entire index, but healthcare, I'll put that on the screen. I will put communication services on the screen and industrials. If you look at these different areas, the earnings and the revenue surprises we saw in 20 and 21, years 20 and 21 were so significant that you could make the argument that we're not necessarily slowing down significantly now. We're just not seeing as many revenue surprises come in simply because we pulled so much economic activity forward into the first part of the pandemic, into those 2020-21 years, that we are seeing a slowdown, which would make sense if you look at the inflationary pressures we saw, which are now coming down, by the way, and I'll talk about that in a second. But you can make a decent argument that throughout the economy, and I'll put consumer discretionary names up here, I'll put information technology names up here. We had so much economic activity being pulled forward from subsequent years into the current years, 20 and 21 in those days, that you could make the argument that we're not necessarily slowing down significantly. We're having a major recession. We're just simply seeing less economic activity than we saw in 20 and 21, which is I think it's a perfectly reasonable argument to make, even though we still could have a recession. I don't know, but you could certainly make the case that we're just pulling forward a lot of economic activity into those years due to the spending that occurred during that time. So, okay, next up, inflation, everyone's favorite topic. Inflation is dropping like a stone. In fact, if you look at all items according to the U.S. Bureau of Labor Statistics, which keeps pretty good stuff on this, pretty good data on this stuff. Then if you see all items, year-over-year change in inflation is sinking very quickly. We peaked last year at about, I think it was June 2022, we peaked at about 9.1% on a year-over-year change. If you think about it, people always confuse prices and year-over-year change, right? The important part is year-over-year change in prices. If I go out for a steak, if I went out for a steak 5 years ago, it's not going to cost what it costs now. If I go out for a steak 5 years from today, it's certainly not going to cost what it costs now. Things tend to inflate over time, and usually for an economy that's somewhat healthy if it's managed. The year-over-year change is what's important, not the price. If you look at where we peaked as far as year-over-year change, according to the U.S. Bureau of Labor Statistics, we peaked last year about 9.1%. It is now below 5. It's at 4.99, and it is still sinking. In fact, this most latest report on average showed the first drop in average grocery prices in something like 12 months. So very encouraging there. Inflation is coming down. So that should help things a bit as far as the economic situation most people find themselves in or their spending habits. So very interesting data from sticking with the change year-over-year change theme. Let's look at auto prices again. Okay, auto prices are coming down, believe it or not. According to Manheim, which is probably the most followed, I would think the most followed automotive group index in the country. You ever been to the Manheim auto auctions? They're kind of interesting. They're out in Manheim, Pennsylvania. Year-over-year change for selected market classes, year-over-year change mid-April 2023, this is pretty recent data, in the prices of cars. You're looking at compact cars, luxury, mid-sized cars. Pickups were basically flat. SUVs, vans, and everything all down. We're paying less for food on average than we were as far as, I should say the rate over year change is coming down. The year-over-year change is coming down for automotive prices. So you may not see it quite yet, and you may not feel it quite yet, but whether it's inflation in food, inflation in autos, inflation in a lot of things, inflation across the board is changing at a slower rate. It's changing. It's still relatively higher than historically is, but the year-over-year change is falling and falling fast. Part of that is due. All right, assuming you have to make changes and you feel like it's necessary to make changes and it makes sense for your financial plan to make changes, what should you do? What's the evidence as far as different areas of the economy that tend to perform, and where's there evidence where changes might make sense in a recession? So I'll put this up on the screen. This is kind of an interesting chart that came from Fidelity, courtesy of Fidelity as of March. This is as of March 2021, so it's not quite as current, but of course there's a lot of data behind this chart, so it's interesting. If you look at the different sectors of the economy that tend to perform during a recession, and somewhere there's not a lot of evidence that much changes, it seems to be really, you can make the argument that really diversification is your biggest benefit in a recession, not trying to time things. So based on the sector of which you want to invest and based on your total picture, you're actually probably better off just owning a wide swath of assets and diversifying yourself rather than try and time going in and out of the market, into cash, back in the market, back into cash, back in the market. That historically does not work out well for people. And we talk to people all the time about this, about owning wide swaths of the market, whether it's, even if you're a high net worth investor, maybe you mix in some private credit or private equity or whatever it may be, but you need to own a wide swath of investments in the market. And that's a nice little chart from Fidelity that shows you that, in some areas like materials and energy and communication services, there's not a real demonstrated relationship between how they perform in a recession or not. So own a wide swath of assets. It's your best protection during a recession anyway. It's your best bet going forward anyway. It's the only free lunch that there is. Diversification is the only free lunch. And it's, anyway, it's nice to see it represented like that in an interesting, very interesting chart. So some tend to perform, some tend to overperform, some tend to underperform, and for some, there's just not a lot of great data. So based on that, really diversification is your best bet in general. With that, I'm going to leave it, and whether we have a recession or not, I'm going to leave that for you to determine. I'm not going to in the business of calling recessions, but I know what to do for long-term investors, and that's usually keep buying because it's your best bet anyway. So thank you for sharing some of your time with me. It is your most valuable asset, as I always say. Thanks for watching, and I will be back with you next time. See ya.